Hey, it's Jason Giamboni with eXp Realty. And today, what I want to talk to you about a little bit is financing, different types of mortgages out there. So, if you go to my page, giamboni.com, click on the financing tab here, there's a bunch of helpful info. But I'll scroll down to the types of different loans, closing costs, moving expenses, saving money, home loans. Which one is right for you? So, you have your conventional loan. This is a standard loan where you'll see these typically 5 to 20% down. You have to have a little higher credit rating. You want to get that 20% down if possible to avoid paying what they call PMI, which is private mortgage insurance. That's just an extra fee that they tack on. The mortgage company, the bank, is insuring that you'll pay the loan. So that's basically what that is. But a conventional loan, the thing to look out for here, as I break my screen, is the fixed and adjustable rates. And you're going to look at this for all different types of avenues. So you'll have your fixed rate or your adjustable. And all that means is that, move my little face out of the way here. A fixed rate, you have a 30-year loan, your interest rate, that's what they're talking about, fixed or adjustable. What is fixed? The interest rate is fixed over 30 years. So if you get a loan and your interest rate is 4% for the whole 30 years, it can't go up. It's fixed at 4%. Adjustable, which I do not recommend, is that it can fluctuate. It's adjusting based on the market conditions. So say if your initial term is 4%, something happens with the stock market or pandemic or whatever, the rate could go up or down based on different things that you're not affected, which could affect your mortgage payment. So your mortgage payment is $500 and now it's $750 because the interest rate went higher. So you want to stay away from adjustable and go with fixed. All right. Clear all the drawings here. Next type of loan is your FHA loan. So it talks about down payments and your interest rates here. So if you want more info on it, just hit up my page and click on that financing tab. But the other types of loan, FHA loan, that's the Federal Housing Authority. And what they do is it's a government-backed loan. The nice part about this loan is you could have a lower credit score and you can have a lower down payment. Typically with FHA loans, you could get a house as little as 3.5% down. So $100,000 house, your down payment is 3.5%, and then you'll have your closing costs on top of that. But a lot of the times what you can do is do what they call a seller's assist, and that rolls in a lot of your closing costs into the loan as well. So it keeps you a little, out of pocket money, keeps that down and your down payment down. So FHA, super common. One of the things that you have to be aware of with FHA loans are, it's the government. So they require certain things to be fixed. You can't, distressed properties probably aren't going to qualify for them. They're going to require the home seller to fix things. They need like handrails, peeling paint, stuff like that you'll see for FHA loans, but I'll get you through it. Another type of loan, VA loan. Love this loan. This supports the military, Veterans Administration loan. The beautiful part about this for our vets, which is nice, is that it's 0% down. So 0 down to get a house. And like I said, you can still do that seller's assist to bundle in your closing costs with that too. So super, super awesome way to get in. And without any PMI insurance for that too. So the VA, trying to help out the military and the government agencies. So, awesome way. If you're part of that, congratulations. Thank you for your support. Would love it. Get my little military on for you. But yep, awesome type of loan. And then the last couple type of loans that I want to talk about is the USDA loan. This is for like agriculture. USDA, yes, you read that right. The same people that grade your meat will loan you money for your house. It's usually like farmland and things like that, but you could get it for 0% down too. The house has to meet certain requirements like the zoning and all that kind of stuff, but we could look into that for you too if that's an option. You're looking for something in a rural setting, this is a common type of thing. And the last loan here, 203K loans. So what's a 203K loan? It's a rehab loan. So basically you have a house that has a lot of deferred maintenance. You want to renovate the kitchen, the bathrooms, all that kind of stuff, get it fixed up nice. So when you move in, you could get a 203K loan. So they'll loan you the money for the house, and the bank will also loan you the money for the rehab. Now they're not just going to give you the money for the rehab. They're, if you have $40,000 in rehab costs, they're not just going to say, here, go for it. There's a process to it. It's the bank, a lot of paperwork and a lot of things that you have to go through. So you'll have to get scopes of works and bids and contracts and all that kind of stuff from contractors for the scope of work. You submit them to the bank. Then the bank, has got to approve everything. The contractor will go do a portion of the work. The bank sends somebody in there to inspect to make sure the work's done. If the work's done, then they'll send the money to the contractor and pay them. And then, as the phases of the project go along, they'll disperse that money out accordingly based on, what's actually done. So a little bit more tricky, but like I said, I could help you out through all these types of loans. Give me a call if you have any questions, or take a look at some of the resources on my webpage. More than happy to help you out.